Okay. Before you start, Essence, hold on, because we can't hear you talking. I'm trying to unmute you, or if you're able to unmute.
Y'all can hear me? Sorry.
Yes.
Okay. Thank you. And there you go, Kara. I didn't realize I didn't probably make you a host all the way yet. Okay, so if you are here tonight, you have already seen this information, or hopefully you have watched a recording if you have come in on a recent onboarding. Okay, so I'm going to ask you guys some questions tonight to hopefully, to clarify the information. But if you've already reviewed it, it will be clear to you the questions that you have, to basically make things more clear for you. So we're going to be covering filing statuses, credits, and deductions in an intro to due diligence. So our mission tonight is to transform you into a confident, compliant tax professional who can navigate complex scenarios with ease, and communicate clearly with clients at every level of tax sophistication. Okay, so there are 5 filing statuses. So we have single, we have married filing jointly, we have married filing separately, we have head of household, we have qualifying widower. Single means that the person is basically unmarried or legally separated. Married filing jointly is just that. It is a couple that is married and they are filing together. Married filing separately means each spouse reports their own income and deductions. Head of household is unmarried taxpayer who pays more than half of the cost of maintaining a home for a qualifying person. This provides better rates than a single status. And then you have a qualifying widower. A qualifying widower basically means that the person's spouse died in the last year or two, and the government allows them to carry this status, and they get the same benefits basically as they would have gotten if under their married filing jointly status. If a person is a qualifying widower, they must have dependents though. So if a person has a spouse who died and they do not have dependents, then unfortunately that person has to file as single. That person has to file as single. But if the person has a spouse that has passed, then and they have dependents, then they can take that benefit. All right. So I'm going to run back through a couple of things. So you have a single person. That means that they're unmarried. I'm sorry, y'all, 1 second. So the thing with being single is a person can file single and have dependent. And I don't want to confuse you guys because in general, when we think of a person filing single, we think of a person not having dependents. But a person that is, let's say you have an individual that have kids but maybe they're living with a family friend, or they're just staying with somebody else who's claiming head of household. They don't make enough money to be head of household. So that person can file single and still claim their kids. But because of the type of income that they make, they're going to carry their kids, but they cannot be head of household. And I'll explain more about head of household when we get there. So a single person technically is an unmarried individual that's not carrying dependents, but a single individual can also be a person with dependents that have a very low income. So you can have a mom that have 2 kids. Maybe she made like $15,000 for the year driving Uber. She lived with a family friend. She's not paying more than 50% to run or deduct a household. So she's not head of household, but she can still claim her dependents. But her filing status is single. Okay. And if you have questions about that, we'll go over it at the end. But I do want you guys to understand that this previously it's kind of been understood that if a person had dependents, that person is filing head of household. But if a person, just because they have kids to claim, but they made $10,000 for the year, they're not head of household, because how can you pay for the cost of a household, kids, food, everything that goes with that, and you made $10,000 for the year and you have 2 kids? So you're not head of household. You're single with 2 kids, and then you're getting the credits that come along with carrying those 2 kids, but the filing status is actually single. And a lot of times, even if you mark that person head of household, the refund amount would be the same. But sometimes clients say, oh, well, you put me as single, but I'm head of household. No, you're not head of household, because you don't make enough income technically to be head of household. And even if you change the status to head of household, the refund amount is still the same. But this is a point of education for our clients, so that you can explain to them why they are single and not head of household. With the married filing jointly, that is just that. You got a couple that's coming together, they're filing together, they're bringing together all of their income and their expenses. Married filing separately. Married filing separately is one of those other special filing statuses, because it's almost as if the government penalizes couples for filing this way. And even if you have one person, so let's say you got a married couple, they separated, one person going files before the other. If the husband or the wife files first and they file married filing separately versus single, the other spouse is forced to file that way. When the person files married filing separately, the software will ask, well, what is your spouse name? What is your spouse social security number? Did you live in the same household with your spouse anytime throughout the tax season within the last 6 months? Once one person puts that information in, the other spouse has to file that. If they go in and they try to file separately, the system is going to flag them and say, hey, this person is marked as married filing separately on another return. They must adjust their filing status. Okay. So if you have a person that say, well, I'm married, but we're not together, I want to do married filing separately. One, you have to let them know that you will need their spouse's information. And two, you will have to let them know if, when your spouse goes to file, they will have to file this filing status as well. The next thing with the married filing separately status is, it's almost, when I say penalized, certain credits and deductions that you get with other filing statuses, you cannot get with the married filing separately. So there is, you don't get the EIC or the CTC, the child tax credit. So you have dependents on there, but you're not getting those full credits because you're married filing separately. So you will see like the person is actually penalized for this filing status. And this is a moment for you to be able to educate your client in the event that they are saying that they want to use this filing status. If it's their filing status, it just is what it is. But sometimes they may have kids, or they may be trying to do like an education credit, and they like, well, I thought that I would get back more. You have to let them know that because of their filing status, the government does not allow them to take advantage of certain credits. Now, head of household. Head of household means that the individual maintain over 50% to run this run a household. So you will be surprised at the number of individuals that think. You will even have some single people that will fill out their intake form and will put head of household, because people think that head of household means I'm the boss, I run this, I pay all the bills. But that is not what head of household means. Head of household means that this person is covering over 50% or 51% of the cost of operating this home. So only one person in the household can claim head of household. Only one person. And if you have two people that are roommates, two people living together, the tiebreaker is basically with the person who makes the most. So even if both people pay equally the same amount, the person who makes the most in the situation technically is the one who trumps or has the right to claim the head of household filing status. So people will say, well, we live together. I got my own kids. They got their own kids. This, that, and the third, it don't matter. Only one person at one address can file head of household according to the IRS. And then again, with the qualifying widower, this allows a person who has a deceased spouse to take the same benefits as married filing jointly. Married filing jointly, but in order to do so, they have to have dependents. If the spouse died and they don't have dependents, then they just have to file single at that point. So let's look at this. Filing requirements for who must file. So a lot of times, especially for my new preparers, the question is, people will sometimes come and say, well, do I have to file? How do I know that I have to file taxes? I worked a few jobs last year. I only worked there a couple of weeks. Do I need to file? When a person asks you, do they need to file taxes? Our basic answer is looking at their filing status and then looking at the income that they made. So when you look at standard deductions, and these are for 2024, the standard deductions for 2025 are just a little bit higher, and each year seems to increase based off of inflation. So I think all of these are higher by maybe like $1,000 to $1,500 per filing status. So if you got a person that's saying, do I have to file, and they give you their W-2s, if the total amount of their W-2s is less than the standard deduction, they do not have a filing liability. So for single, so like I said, this is for 2024. The amount for 2025 is a little bit higher, and you guys can look that up, just standard deductions for 2025, but we're going to use these numbers for the sake of tonight. So if I'm coming to you and I'm saying, hey, Serenity, I want you to file my taxes, but I ain't sure if I made enough money to file. And I give you my W-2s. Serenity is going to tally up how much I made at each job. And if I made $11,500, guess what? I don't technically have to file. I don't have to worry about the IRS coming after me or anything, because I didn't make enough money to have a filing liability. Now, although I made less than the standard deduction, which is $13,850, if I made $11,500, but let's say I had $625 withheld in taxes, Serenity will say, hey, technically you don't have to file, but I can go ahead and still file your taxes and get you back the money you paid in because you actually paid taxes, but you didn't have to pay taxes because you don't have to file. So we can still file them and get that money back for them. Okay, so for every filing status, this tells us the minimum amount of money that we could have made in order to that we have to file. So as a single individual, if I'm single, I don't have no kids, I drove Uber and I made $20,000, I have to file. If I'm married filing jointly, both together, if we made more than $27,000, we have to file. Married head of household made over 22,000, you have to file. And self-employed is more than 400. And I want you guys to take note of the 400 for the self-employed because that is the lowest. All of these other standard deductions are very high. So it's a lot of money that the person could have made on a job and they don't have to file. But for a self-employed person who is not working a job, if they just made a minimum of $400, the IRS do want them to still file taxes. So when you are asking your clients about the information, about the income that they made for the year, you also always want to ask them, did they do anything on the side? So when you see this pro tip here, I always ask clients about side gigs, freelance work, or cash payments. That $500 in Uber driving or freelance graphic design work could trigger a filing requirement. So make sure that you always ask your clients about that. So let's talk refundable versus not refundable versus non-refundable. And the difference is basically in the name. So you got refundable credits, you got non-refundable credits. Refundable credits are those credits that if a person qualifies for them, they go towards creating a refund for the client. So all credits initially will reduce the amount that you owe the IRS, but if the amount is already at zero that you owe the IRS, then the rest of that money can be given to you as a refund. That means that makes that a refundable credit. For non-refundable credits, that means you may qualify for this particular credit, but if you don't have a tax liability, if you don't already owe taxes, all this will do will zero out how much you owe the IRS. But even if the credit is more than what you owe, it will not result in a refund. So refundable means that if there's overage, you will get a refund. Non-refundable credits mean it will just zero you out if you owe the government. And if there's anything left, it does not refund. You just break even. So examples of refundable credits is the Earned Income Credit, EIC, Additional Child Tax Credit, the Premium Tax Credit, which is the 1095A for the healthcare, the American Opportunity Credit, which is the credit for individuals that are currently in school. Non-refundable credits are your child tax credit. So a portion of the child tax credit is not refundable. The child dependent credit, the daycare credit. I think we talked about that in one of the classes last week, but basically for like the child care is normally up to like 3,000. I think it's 6,000 for 2 or more kids. But once you get the credit, if there's anything left, again, it does not go to creating you a refund, but it helps reduce the amount that you owe. You got the savers credit, which is the retirement contribution incentive. And then you got the lifetime learning credit up to 2,000 for continuing education. So for the school credit is 2. One is the American Opportunity Credit, which you can claim up to 4 years, which is mostly used for undergraduate people in undergrad school. And then a lifetime learning credit, you can claim that as much as possible. I know some people are like lifetime students or whatever like that, you can claim that for forever. But the American Opportunity Credit, which is the refundable credit, it maxes out at you being able to carry it for 4 years. So client, this is an example. Client owes $500 in taxes but qualifies for $1,000 refundable credit. Result is $500 refund check. Same client with $1,000 non-refundable credit would owe zero, but will receive no additional refund. So when we're putting in everything, if a client owes $500 in taxes, but they qualify for $1,000 refundable credit, so let's say they qualify for the earned income credit. At first, it was showing that they owed $500. We put in the EIC. Now the EIC gave them $1,000 credit, so it take away the $500 they owe, and then they would be getting a $500 refund versus the $1,000 non-refundable. If that same client was owing $500 in taxes, we put in the daycare credit for them, and now the daycare credit, it just take them down to zero, but it does not result in a refund. And I'm going to take questions at the end, guys, so just make sure you write down any questions for anything that's not clear for what I'm going over for you guys. So some common tax credits. Earned income credit is the most significant refundable credit for low to moderate income working families. Earned income credit is normally like the bulk of most refunds that go out. Earned income is actually up to about $8,000 this tax season. So these numbers are from 2024. Some of these credits have definitely adjusted for the upcoming tax season. The child tax credit is, I believe, $2,200 per qualifying child under 17. I think the refundable amount is $1,700, if I'm not mistaken. So the refundable portion, the credit itself is up to $2,200, but only like $1,700. I actually think it's reduced to $1,400. It dropped down some for the upcoming season. So they increased the overall amount of the credit, but the refundable portion is actually a little lower than what it was in prior seasons. And all of these credits, guys, have income limitations. So when I say that the earned income credit is up to $8,000, the more money a person makes, especially once you get over about $40,000, the less of that credit you will see a person get. So it's very much a red flag when a tax preparer is trying to tell people how much money they're gonna be able to get somebody without actually doing their taxes. That is a red flag. So I know every year you guys see those marketing posters out, and it'll say one kid 3,000, two kids 5,000, three kids 10,000. Every situation is different. Everything is based off of the number of kids and also the income and the other factors that go along with what that person's tax situation is. So that is just kind of like a framework. That is just kind of like, oh, if you have the perfect scenario, this is how much you'll get. But it is a red flag for somebody to tell you, oh yeah, you got two kids. Oh yeah, girl, I'm gonna get you back 10,000. I'm gonna get you back 12,000. Nobody can guarantee you the amount of money that they're gonna get you back without actually doing your taxes. And guys, we do things over here legitimately. We do things ethically, and we don't sell our soul for money. So this is very legit over here. You guys are gonna be taught appropriately how to do taxes and the expectations to set with your clients. And when you're not getting notices from the IRS, when you're not getting audited, and your buddies and people that you know you will be able to appreciate the education in the offices that you are actually attached to. So I just wanted y'all to be able to see my face while I said that. The education credit. So we talked about that. The American Opportunity Credit normally will be a refund of up to an additional $1,000. The lifetime learning is up to $2,000 per return, but it's not refundable. So it will help how much the person actually owe if they are going to be owing the IRS. The CTC is 3 kids. I need y'all to drop me some hearts or give me some energy because I can't really see y'all and this information is a lot and I just feel like I'm talking. So I want to make sure y'all following me. I'm gonna take y'all questions at the end. I don't want to go too fast. I don't want to go too slow. Okay, I see y'all hearts, but I want to make sure y'all out there. Y'all ain't sleep. Okay. Y'all out there. Okay. Because now we getting into the meat and potatoes. We getting into the real stuff. You know, this stuff ain't always all exciting and stuff, but this is real. Okay, so we got credits versus deductions. Tax credits. Dollar for dollar reduction in the tax amount owed. As $1,000 credit saves exactly $1,000 in taxes, regardless of your tax bracket. Credits are applied after calculating your tax liability and provide direct, immediate savings. So deductions. Deductions reduce taxable income before calculating tax. So the tax credit, your earned income credit, all of that. So if you owe the IRS um $500 and you qualify for this credit and it's $1,000, then it's gonna knock off 500 and you're gonna get refunded 500. With the deduction just saves you a marginal tax rate times 1,000. For someone in a 22% bracket, $1,000 deduction saves 220 in taxes. So deductions are not dollar for dollar. Credits are dollar for dollar. So a deduction versus a credit, which like sometimes when the new laws pass or the new laws come out, and the crazy part is some states will have things like recently some states had where you can claim like even if you had like a miscarriage or an abortion and you had been pregnant, they were given like different type of deductions, and the deduction might say up to 3,000 or 4,000. And I would have tax preparers to say, well, why it didn't really change what they getting, or it didn't really reduce. A deduction is not a dollar for dollar. So people just see the 3,000 and they get excited about that, but they don't understand that it's just gonna reduce what you owe by a percentage, not for dollar. So make sure that you note that first. Is this a credit or is this a deduction? A credit is dollar for dollar. A deduction is a percentage. Okay, so the standard deduction versus itemization. So when Trump was president in 2017, that's kind of initially when everything changed, right? So back in the day, and when I mean back in the day, so starting at 2016 on, the way that the laws were, standard deduction used to be real low. Standard deduction for like head of household used to be like 6,000. 5,000, 7,000, whatever. So Trump said, hey, I'm going to increase the standard deduction. And again, the standard deduction is the amount of money that somebody can make before they have a tax liability. So he increased that very high to a point where itemizations didn't have the same effect. So itemizations are like you paying for out-of-pocket medical costs, you giving to your church, you giving to Goodwill, you if you worked at a warehouse or if you were a medical professional or you work for sanitation, you can write off your uniforms, your boots, your this, your that. You used to can write all of that stuff off and it would make a difference on your tax return. Now we can still plug in all of that information. The mortgage interest, how much somebody gave to their church, how much somebody donated to Goodwill. We can write all of those things. We can plug that information in. But if the amount of write-offs do not exceed the standard deduction, it doesn't make a difference in the bottom line for what the client is getting refund or what they owe. Okay, so the tax software will automatically, if you plug in if you plug in all of the itemizations or the write-offs that they have, the tax software is going to automatically take the greater of the two. So if their write-offs are greater than the standard deduction, then you will see that it will affect their refund. It may reduce the amount that they owe, or it may make their refund a little bit larger, but it has to be greater than the standard deduction. So if you have a person that's filing head of household that say, oh, well, I had surgery last year, and I gave to my church last year, but that information is going to total out to $10,000. The head of household standard deduction is $20,000. So the system is going to automatically take that $20,000 over that. So you can plug that information in. For my experienced tax professionals, you may know this or you should know this. For my novice people, I would like for you to plug it in just so you don't feel like I'm telling you something. You can plug it in for yourself and you can see. But I'm telling you, if the amount of write-offs that they have do not exceed the standard deduction, you're not going to see it make a difference when you're looking at how much they owe or how much they're being refunded. Due diligence and protecting your practice. So it's a lot to be said about this. Due diligence is very, 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 very heavy. And you're going to hear us talking a lot about due diligence during the tax season and continuing to lead up through these trainings. Due diligence is us doing our jobs as tax professionals. So one, to be able to do taxes is already not really regulated. Like, you don't have to go to school. It's nobody saying, well, you got to have X, Y, and Z to be able to prepare anybody taxes. At most, you just don't have to have any felonies. You get your P10 and you can start doing people taxes. And you are held to a standard. You are held to knowing certain things and doing certain things, whether you have studied, taken CEs, taken a course, gotten any type of training, right? So due diligence means that I did my job as a tax professional, that any credit that I put on somebody's tax return, I am also stating that I've checked with this person, I've received documentation, I've asked a certain number of questions to note that this person qualifies for this credit. So every credit that we put on somebody's tax return, we are held accountable. Every tax return that you complete will have your name and your P10 attached to it. So you can't just say, well, they told me, they said. You have to also show that although this person told you this, I dug a little bit deeper to make sure that they actually qualify for this. So it's the same thing as saying, let's say if you know that somebody been drinking and they say, well, no, I haven't been drinking, and you go ahead and give them their keys and they get in the car and they drive off and they have an accident, but although they said they hadn't been drinking, you know their breath smelled like alcohol, you know that they were stanky leg, wiggly leg on their way out the door, you know that they eyes was crossing, but just because they said that they weren't drinking, you went ahead and gave them their keys. So the math is not mathing that you did your due diligence to meet this person exemplified all types of signs to you that they are actually drunk. I need to ask more questions. I might need to hold their keys. So that's the same thing with taxes. If a person is saying, well, they want to claim a child, or they want to claim a credit, we have to do due diligence. We have to ask questions to make sure that these people qualify for these credits that we're putting on their tax return. And if we are audited, the IRS can fine us up to $600 per credit that we put onto somebody's tax return that they're not actually eligible for. So this is why we take this very serious. It's not just about getting a refund for somebody. It's also about us doing our jobs. So 1, eligibility requirements. We want to verify that the taxpayer meets all legal requirements for each credit, deduction, or filing position claim. So the child tax credit, the earned income credit, those are the two most widely abused credits. So somebody can't just show up with a child and say, this is my son or my daughter, and they don't have a social, they don't have any insurance, they don't have any school documents, they have nothing to tie this child to them, but they're saying that they're claiming them, this child lived with them. How can you prove that? Next, accurate computations. Ensure all calculations are mathematically correct and follow current law. This includes properly applying income limitations, phase out, interaction between different tax provisions. The software helps, but you must also understand the underlying calculations. Knowledge standard. You must know what you don't know. When facing unfamiliar situations, research current law, consult reliable sources, or refer to specialists. Continual education isn't just for compliance, it's for competence. So we will continue to have classes and courses through December, and then some education will be in real time during tax season. So when your tax return is being reviewed, or when compliance is reaching out to you, or when your team manager is reaching out to you, don't be offended. It's going to be a learning experience, but there will be a lot of questions asked about how did you get to this calculation, whether or not you got proper documentation. It's all for us to cover ourselves, because again, your name and PTN will be on that tax return, and then whatever office you are filing with, we also hold liability because it's being transmitted through our eFin. Proper record keeping. Document your due diligence effort. Keep records of questions asked, documents reviewed, and research conducted. Okay, so as tax professionals, we have a legal responsibility to maintain records for up to 3 years. So even if you come and do taxes and you do 5 people and you never do taxes again, you have a legal responsibility to maintain the records for those 5 clients that you filed and everything that came with that, and however you came to conclusion that these individuals can claim the credits that you put onto that person's tax return. Okay, and we have innocent spouse versus injured spouse. So this is another big thing. These two forms address completely different problems and are frequently confused. Mastering this distinction demonstrates advanced tax knowledge and helps you serve clients facing marital tax complications. So, have you guys heard of the innocent spouse or the injured spouse form? Is there anybody here who have already heard of these forms, or maybe used them for yourself? Okay, some people saying yes. I had a couple no's. So the injured spouse is more popular than the innocent spouse. The injured spouse gives protection for your portion of a joint refund from a spouse debt offset. So joint refund intercepted for your spouse's child support, student loans, or other federal student debts. Protection, refund allocation, get your share, your refund released. So if maybe you got married this year, or your client got married in 2025, they filing for 2026, this person, the husband already knows that their taxes is gonna be taken because the ex is mad that he now married and she didn't put him on child support. But you saying, hey, we're married, we're filing together. I need my money. He had those problems before he got with me. So you can take whatever refund he was gonna get, but I need mine. That is what the injured spouse is. It allows the spouse that didn't have nothing to do with that because this was going on before they got married to be able to still get their portion of the refund. The innocent spouse, which is Form 8857, gives relief for the spouse who have errors or omissions on a joint return. So you can see this a lot of times. Sometimes when people are married, there is one person um, who maybe takes control of the tax return, or they like handle the filing. And sometimes the person who does not handle the filing may not know everything that's being reported. So, like if you are married and your spouse makes most of the money, and maybe you are at home wife and the spouse has a gambling problem and you don't know about it. So the husband hit a 50,000 in gambling winnings, filed joint return showing lower income. IRS audits and assessed additional tax. So y'all was married, the husband underreported the income, and now they saying y'all owe more money, but now y'all not no longer together. Y'all not no longer together, and you like, hey, I didn't even work when I was with him. I was a kept woman. I ain't know nothing about that. And now I'm on to my new life. I'm not even no longer with this person. I don't owe those monies. So the innocent spouse will allow you to be able to not be held accountable for that additional tax debt that can be owed to the IRS that you didn't have any knowledge of. And of course, they may make you prove that. So innocent spouse is you basically saying that this person is now having some tax issues. I was unaware of it. I don't have nothing to do with it. I have moved on, and I don't want to be my social to be attached to what this person owes. The injured spouse, y'all can still be together. Y'all might be newly together. Y'all might be married, but hey, he had some issues before me. I love him, but I need my refund. So that is the difference between those. Innocent spouse is 8857, and that form is normally mailed in, whereas form 8379, the injured spouse is normally filed electronically with the actual return for the season. Okay, so that pretty much sums up the first PowerPoint. Are there any questions related to any information, credits, deductions, filing statuses, injured or okay, common tax documents. Hold on, yeah. Mhm. Okay. All right, professional tax preparation mastery, common tax documents, client intake process, and due diligence standards. So this, we will provide actionable insights and best practices to ensure compliance, mitigate risk, deliver the highest level of professional service to your clients. We are dedicated to helping you achieve excellence in every return you file. Okay, so we're basically talking about common tax documents that you guys will be receiving and seeing. So you got Form W-2. We all know every tax season, that's basically all we're talking about is, did you get your W-2s? Did you get your W-2s? The W-2 is the statement that is reported to the IRS that tells the IRS how much an employer paid you and how much taxes you pay and other things that you pay. So state taxes, federal taxes, FICA, Medicare, whether your employer paid some of your dependent benefits, if you paid into retirement, etc. Form W-4. So make sure y'all know the difference between a W-2 and a W-4, okay? All of these numbers, W-2, W-4, 1099, all of these things are tax codes. So you don't want to just be like, oh, W-4, W-2, know what you're talking about. W-2 refers to employer income. And that is the form that we are looking for every year from most tax-paying individuals. The W-4, which I talked about the last time we were together, I believe, I don't know if I talked about the software training. One of the trainers, I talked about the W-4. The W-4 is the form that we fill out when we start a new job to tell our employer how much taxes to withhold from our earnings. Okay? W-2 reports our earnings. The W-4 is a form that we fill out when we start a job to say, hey, I'm head of household. I got 3 kids. Withhold my taxes based off of this. The W-4 is the form that say, hey, I got no kids. I'm single. Withhold my taxes at this rate. The W-4 is the form that I told you guys to go ahead and make a social media status about, because people gonna come in January, February, March, and they're gonna swear, oh, I did pay taxes, I did, and they didn't. So now is the time for people to be looking at that W-4. Really, it's been time for them to look at it, and the W-4 should be looked at every single year. A lot of times when people start a job, they complete that W-4 and they never look at it again as long as they're on their job. But your tax situation can change based off of, did you get married? Did you get divorced? Did you have kids? Are your kids now graduated high school and going to college and gonna be filing their own taxes and you're not gonna be able to claim them? So one thing that people like to say is basically, people just feel like their tax situation is their tax situation. And it's no such thing as that. Everything changes based off of what's going on in your life. So in general, there may be a time, I mean, if you got young kids or you got little kids, you're married or whatever like that, you're making the same amount of income, there is a possibility that nothing changes, but it's not just etched in stone that this is my tax situation. So you will see that you will have clients that will say, well, I get back 6,000 every year. It's like, no, last year your son was 16. Now he's 17. You got a $2,000 credit for him last year. This year you only getting $500. So everything can change. So everything is reviewed every single year. There's no such thing as always when we're filing taxes. The other thing with the W-2, guys, is that W-2s can only be filed in the year that they were earned. So it's so common that people say, well, can I go ahead and file? So some people will come to you in January. Can I go ahead and file? I got my 2 main W-2s. I got one more W-2, but I only worked there like 3 weeks. I just file that next year. It don't work like that. In 2025, if the if the earnings was made in 2025, it has to be filed with 2025. So even if they leave off the W-2, then you have to come back and amend that year return. You can't be like, oh, well, they ain't filed it, so I'm gonna put it with 2026. It don't work like that. The year that the income was earned is the year that the income has to be filed. The year that the income was earned is the year that the income has to be filed. And the other thing is this information is already reported to the IRS. I don't know why people feel like they tricking the IRS, they outsmarting the IRS. The IRS is basically waiting for you to report back what's already been reported to them, and they just gonna match it up. So it's like, okay, well, this Burger King reported on this person, Taco Bell reported on this person, Pizza Hut reported on this person, and now you then came in and you just reported Taco Bell and Burger King because Pizza Hut taking too long. And then guess what? The IRS like, well, we ain't passed out your refund because what we got is reported to us don't match up what you said you earned. So the IRS has really become smart over the years. So make sure when your clients reporting their income, especially those people that's filing super early, like late January, early February, you want to ask them, are you sure this is all of your earnings? Because if not, the refund can be held up. And if the person is paying from their refund, we don't get paid until they get paid. So if the IRS don't release no money because they didn't report all their income, ain't nobody getting no money. You got Social Security benefits and interest income forms, 1099 SSA and 1099 INT. In general, Social Security benefits are not taxable, guys. In general, people will give you their Social Security their forms, and you can just plug it in. Like if all they got is Social Security and they didn't do nothing else, they don't have a filing liability. And people will come to you and they will give you that, and you can plug it in if you want to. You can see it's going to result in zero. It's not taxable, whatever. But if a person is getting Social Security benefit and they also worked a job or they also had a business, depending on how much money they earned, a part of their Social Security benefits can become taxable if they made too much money. So the federal government will establish a guideline every single year that will determine, okay, you can make up to 16,000, 17,000. It's normally somewhere between like 17 and 21 or 22,000. Once you exceed that, the government may tax some of your benefits. So if a person is coming to you and they have Social Security benefits, then you want to question them. Did you do anything on the side? Did you operate a business? Do you have any W-2 income? But in general, the Social Security benefits by themselves are not taxable. Form 1099 INT is an interest income. So you normally see those given out by like banks. So if people have CDs or accounts that's earning interest, they may have a 1099 and you just plug that in. Forms W-2G and 2441. So W-2G is gambling. So if you have people who have earnings from, they have gambling winnings to report, you want to make sure that you get this information. The former documents the gross amount of winnings along with federal income tax withheld. Reportable gambling winnings include lottery prizes over $600, slot machine jackpots over $1,200, Keno winnings exceeding $1,500, poker tournament winnings above $5,000. Recipients must report these winnings on their federal income tax return, even if taxes were already paid. So if a person tell you that I had some gambling winnings, but I already paid my taxes on it, it still has to be reported, and they will have a tax form. So let them know that it must be reported if they have that W-2G. Form 2441, child and dependent care expenses. This is for individuals who have children under the age of 13, who is physically or mentally incapable of self-care, who live with you for more than half the year. The credit is calculated as a percentage of qualifying expenses up to $3,000 for one qualifying child, $6,000 for two or more, and ranges from 20 to 35% of the depending on the adjusted gross income. Taxpayer must provide name, address, tax identification. So for the child dependent, if a person say, "Oh, well, my child," remember I was telling y'all that the child, the 2441 don't cover for no private tuition because that person child go to a private school. This is only for after school. If the person kid go to YMCA or child dependent care, or even if they pay somebody private. So if they say, well, yeah, my sister keep my kids for me, in order for them to take advantage of that credit, we will need the sister's first name, address, and social security number. If you cannot get that information, you cannot claim that credit. The same for the school. Most times people do have their child dependent credit forms, but these daycares know that people need this information. I don't know why seemingly like it's so hard, but we have to have the tax ID number, which is the EIN. We have to have the address for the school and the name. Okay? If they don't have that information, they cannot claim the credit. It's not us. It ain't us being mean. They have to take that up with the IRS. Forms 8862 and 8879, credits, claim, and e-filing authorization. So Form 8862 represents a critical compliance tool required when taxpayers seek to reclaim refundable credits that were previously disallowed by the IRS. So if you have a client and the IRS denied them the right to be able to claim earned income credit or child tax credit, their return may be rejected. So we talk about that in software training about returns that are rejected, and we seen a button that you can click. If you see a rejection from Form 8862, the software will prompt you, and we can actually fill out this form inside of the software. You would just ask your client about it, ask them why. Was it because they didn't have the right to claim those kids, or was it based off of income? We will plug in that information, and most likely the IRS will allow them to reclaim that information. Form 8879 is IRS e-file signature authorization, which is just basically a form that was saying that the taxpayer gave legal consent to electronically file their return and confirms their agreement with all the information contained in the return. So guys, anytime we complete a tax return, that information must be sent over to the client, and we can do that within the software. And we'll be diving into that on next Tuesday. We can send the return directly to the client for them to review and place their signature onto the tax return if they don't have any questions or concerns. Due diligence and investment reporting. So you got I believe in the last software training, we will dive more into the paid preparers due diligence checklist. But like I said, guys, we are heavy with due diligence, making sure that we are doing our part to make sure that taxpayers qualify for all of the credits that we are putting on their tax return. So there is a form that comes up at the end of the tax return that asks us certain questions. And it asks us, like, did you ask the appropriate questions for this person to be able to file head of household? Did you maintain documents? Did you depend on documents? If so, what did you depend on? Was this person a resident of the U.S. all year long? So they ask certain questions at the very last bit before we actually e-file to give you an opportunity to say, hey, this is your last chance to make sure that you ask the appropriate question to be able to qualify this individual for every credit that you have placed on their tax return. Form 8949, sales and disposition of capital asset. This mostly would be related to like our sales of stocks, bonds, mutual funds, real estate investments, crypto. And this was heavy during like COVID and stuff like that. The last couple of years, I haven't had so many clients that had these things, but you know, like outside of even just like Coinbase and uh God, I'm drawing a blank. What is the other one? I want to say Red Robin, but that's not it. Another very common one, you know, you had like Cash App where you could buy stocks. It was just like a lot of platforms where you can just buy and exchange stocks. So if people was like cashing out and earning money, yes, Tara, Robin Hood. I said Red Robin. Yes, Robin Hood. There was people was having a lot of forums because they were selling, trading, and doing different things. But there are still a lot of people into day trading. So you can just ask about this. But if you see Form 8949, you know what this is about. And then I showed y'all yesterday, not yesterday, but on Tuesday in training on the software, like going through the publication. If you're unsure about what a form uh, is about, you can go on there and search it and find all of the information directly that's related to the IRS site. Mortgage interest and debt forgiveness. So again, if a person owns a home, you do want to get their mortgage interest statement. That is Form 1098. And I think I had touched on this in training too. You see down here where it says Tax Cut and Job Act limited mortgage deductions to interest on acquisition indebtedness up to $750,000. So if a person bought a home for $750,000, they qualify for additional like credits than someone in a regular home. But just depending on how much interest that person paid, it can still be significant. And with the mortgage interest, again, this will be one of those itemized deductions. So based off of how much they paid, will determine how this will reflect how much they owe or if it will increase their refund. 1099-C is a cancellation of debt. So cancellation of debt is with the 1099-C is basically for individuals who have had debt forgiven. So this is a learning moment for you all if you don't know. So in the event if you have debt and the creditor settles with you, any forgiven debt is sent to you pretty much as a 1099-C, and you have to claim that as income. So like let's say you had a car that was totaled out and you still owed on it, and you like, okay, well, I don't want to pay this. I can't drive this car. It's totaled out and I need to get me a new car. I'm not paying for this. So if you owe $10,000 on it and you know they said, okay, well, we'll settle with you for $1,000. You go ahead and pay us $1,000 and we'll consider it paid. They'll send you a 1099-C for $9,000, and this has to be claimed with your taxes as income. Health insurance and education tax forms. So every year clients will send, normally they'll upload, they'll have either a 1095 A, B, or C. 1095 B and C are normally insurances that are provided by the taxpayer's employer. A 1095 B or C does not have to be uploaded to the tax software. It does not. Prior to 2017, it actually individuals were penalized for not having health insurance. People were penalized. So if you would put in there that the person didn't have anything, they were penalized. Trump came in, he said, if you don't have insurance, it just is what it is. But the 1095A insurance, which is the Obamacare insurance through the marketplace, that comes with a tax credit. The government is actually paying part of your insurance on your behalf, and then based off of how much money you make for the year, you may qualify for all, some, or none of that credit, which can influence whether you owe the government or um, if you're getting additional refunds. So the 1095A, if a person has insurance through the marketplace, if the person has insurance through Obamacare, we need that form. If the person has insurance through their employer, we do not need it. We don't have it. We don't have to do anything with it. But if they have a 1095A where they had insurance through the marketplace, which this is a lot of entrepreneurs, if a person is an entrepreneur, or maybe if they were unemployed for some time throughout the tax season, they have this. In prior years, it used to be the tax software is going to ask you, did you have insurance through the marketplace? And you have to put yes or no. When we transmit the return, if it comes back that this person had insurance through there, the return will reject, and the IRS will not accept it without us putting the information in. A lot of people will say, no, I didn't have it, I didn't have it. And we have the resources and the tools that we can give to the client to have them call. And even though they going to say, I didn't have it, I didn't do it, I don't know, they'll come back with the form and they'll just be, they don't even be like, well, sorry or nothing. They just be like, oh, here it go. It's like, okay. But if we push the return through without it, the refund, if they're supposed to be getting one, can be held up. So if a person is adamant that they don't have it, we really want to still have them call and check. I don't know how it seemingly is that people is having this come about, but it's very popular now, and people be having it even though they swear they don't. And so we want to go through everything. So if we say, hey, your client return rejected, is showing that they had a 1095A, we'll send you the link so they can call in and verify whatever like that. Just give them the opportunity to kind of go through the motions, because they will be so adamant that they didn't have it, and then they'll all of a sudden come back with it. The 1098E, the student loan interest. This is a big thing. We know that the student loans are back in effect. The student loans are full-fledged back in effect. So we want to ask our clients, did you pay any student loan interest, especially if they're looking like they owe taxes? This is one thing that they can produce that can help them reduce the amount that they owe. Form 1098T, which is the tuition statement. This is the form that will allow the taxpayer to qualify for the American Opportunity Credit or the Lifetime Learning Credit. And those are the school credits that we talked about. The American Opportunity Credit can be a refundable credit up to $1,000. And then the American Opportunity Credit is up to $2,500 per eligible student for the first 4 years of post-secondary education. And if they want to claim those credits, they have to have this form. So if a person said they went to school, they said they paid this, that, and the third, they have to produce it, and that is a 1098T. Unemployment compensation, 1099G, and the 1099 NEC. So the 1099C is government payments. Unemployment is taxable. Unemployment is taxable. If a person got unemployment, it must be reported, and they should have paid taxes from it. And if they didn't pay taxes from it, they're going to now pay now that they're filing. The 1099 NEC is non-employee compensation. So 1099s is basically for all freelance work. So like how y'all coming in to be tax preparers, next year for all your earnings that you make in 2026, you will receive a 1099 for all earnings over $600. If you make over $600 in 2026, you will get a 1099 NEC. So 1099 NEC is issued out by Uber, by Lyft, by Ship, by DoorDash. If the person made over $600, they will have a 1099 NEC. And who can tell me, for the self-employed person, what's the minimum amount of income that they earn that they need to report? Where my chat at? Okay. Oh,
100.
and that is correct. I don't know who said that, but that is correct. I was trying to see if y'all woke. Miscellaneous income and dividends forms 1099 miscellaneous, 1099 DIV, and 1099K. So 1099 miscellaneous. Miscellaneous is pretty much reports like royalties and rents and stuff. The 1099 miscellaneous used to cover everything. So 1099 miscellaneous used to cover rents and royalties. So royalties is like if a person writes a book or something like that, and it would cover like freelance work, like tax preparation, DoorDash, whatever. But they have now pretty much separated for the 1099 miscellaneous to just be like for royalties, and rents and stuff, and then the 1099 NEC for everything else. But sometimes I see a lot of small businesses who, I ain't gonna say they don't know what they're doing, but maybe they just haven't been educated or updated. So you may get some companies that's reporting like freelance work on a 1099 miscellaneous, but it's really a 1099 NEC. Form 1099 DIV is for dividends and distributions, which comes from stocks, mutual funds, and other investments. 1099K, you heard there's been a lot of talks back and forth over the years about this. So one moment they say the report ends at 600, the next they say up to 20,000. The threshold has still been at 600, and then I think they took it to like 5,000. So a 1099K is like if a person is selling digital products, or if a person processes credit cards and they produce over $600, the merchant is going to send them a 1099K for the earnings that they made through their credit card processing. That is what a 1099K is. And a 1099K, a 1099C, a 1099 NEC will all result in you having to file a Schedule C. Okay, so let's get into talking about the client intake process. So we've been talking a little bit about like collecting client information, building our clientele. So tonight we need to really address, like, as we're getting closer into building a clientele, what does that look like? Where are we housing this information? What are we doing? What are our processes looking like? So we talked a little bit about the CRM, which is a one-stop shop that will allow you to do everything. And if you are interested in that, please get with your office manager and we will give you access so you can check out the CRM. If not, then you looking at individual processes like the Calendly, like the job form. You have to have a system to be able to gather your clients' information and then collect that information and put it into the tax software. So let's see. The client intake process overview. So the client intake process represents the most critical phase in professional tax preparation, setting the foundation for accuracy, compliance, and client satisfaction. A comprehensive intake process protects both preparer and client by ensuring complete information gathering, proper identity verification, and document due diligence. So once, even if you're making a social media post like, hey, I'm doing taxes, file with me. So one, Do you send them a calendar link so they can get on your calendar? And then once they get on your calendar, what information are you collecting from them? So the client relationships begins with the first contact, whether through referral, website, inquiry, social media, or direct marketing. The initial touch point sets the tone for professionalism, service quality, capture essential information immediately. So you need to be collecting the full name, the email address, the phone number, preferred communication method at a minimum. Identity verification. We want to, before discussing any financial information, always verify client identity to prevent fraud and identity theft. Request government issued photo identification for both taxpayer and spouse. Social security cards for all dependents being claimed. Proof of address such as utility bills, lease agreements. The IRS mandates identity verification as part of due diligence compliance, particularly for credits like earned income credit. Document the verification process in your client file, noting ID types reviewed, types of verification. Never proceed return preparation without proper identity verification. This protects your practice from participating in fraudulent returns and demonstrate professional due diligence. So you would create a form or have a form, and we will, I guess, put either, I don't know, they will come out via email or put it in the school, some samples of intake forms. I don't know if I have one attached to this, so we'll see when I get to the end of this. But again, some of us will be doing taxes in person, and some of us will be doing virtual. Let me put in the chat, one, if you think you're gonna mostly do virtual. Two, if you have an office or a space where you'll meet people in person. One for virtual, two for in person. Okay, so mostly, I see mostly ones. So tools are good because you get to meet the people in person. So of course, if somebody gives you their ID, you can look at it, you can tell this is not you. But virtual, we have to take a few more steps. So we might even ask for a selfie with the ID, with them holding a picture of it to make sure that it's them, because you're promoting, you're marketing. You can do taxes for anybody in any state, but we still have to do our due diligence. Okay, so it's like, okay, on my intake form, a requirement is for you to upload a your identity, which you hold in your ID in front of you. So you can be able to tell right then and there, does this look like this person or does it not? And then the other supporting documents, they got a lease, they got their address, they got a utility bill, they have other supporting documents that verify that this is them. So provide clients with a comprehensive document checklist. So we want to have all of their W-2s, their 1099s, their mortgage interest statement, their health insurance. We need dependent documentation. So we need socials, birth certificates, school records. You don't have to have all of those different things, but you need at least one or two of those things to make you feel secure that this is actually this person. This is actually their kids. And nothing is, I actually would prefer the birth certificates over the Social Security. You need the Social Security number, but the birth certificate proves the relationship. Intake and interview questionnaire. Conduct a structured interview to verify information and probe for additional tax relevant details. This conversation goes beyond simple collecting forms. It is an opportunity to identify planning opportunities, clarify ambiguous situations, and build client relationships. Ask open-ended questions about life changes, major purchases or sales, business activities, investment transactions, and charitable contributions. Clarify filing statuses, confirm dependent eligibility, verify income sources, and discuss available deductions and credits. Document all responses in detail and store them securely in the client file. This interview serves as the foundation for your due diligence notes and provides critical context for return preparation decisions. Okay, so if the math not math, then we got more questions, and if in doubt, do not move forward. Client intake form, taxpayer information. So this kind of recaps some of the information that you need to collect from the client. And it's better for the client to actually fill out this information and sign that this information is true and accurate, and for you to get the verifiable documents from them versus you handwriting out everything. Now, if a person comes to see you in person, that's different. But when you're doing virtual, you want to send them that intake form. You want to collect those documents, and then you want to ask additional questions to get answers to anything that is unclear or needs additional documentation. This is additional information that will be on the intake form. So spouse information, if they're married, filing jointly, the dependent information. So for any dependent, we need their legal name, their date of birth, their social security, their relationship to the taxpayer, the number of months they live with the taxpayer, confirmation of support, citizenship or residency status. Maintain supporting documentation, including birth certificates, school records, medical records, or other proof of relationship, residency, and support. This documentation is essential for due diligence compliance when claiming credit. How long do we have to maintain the taxpayer information once we prepare their taxes and transmit it to the IRS? Okay, y'all listening? All right, 3 years. 3 years, and I recommend 5 years, but 3 years is our legal responsibility. 3 years. And if we got printed documents, if we got hard files, how do we need to secure those files? If we got physical copies, okay, Kelly said lock files, absolutely. So even if your office at your house, if you got an actual brick and mortar place, yes, lock file cabinets. And they have actually fireproof cabinets now. I would actually get something that is locked and fireproof. But yes, if you in a physical office or even at your home, if you anal like me and you want to just print and have everything, lock files. Nothing should be left out or accessible. I see y'all. I'm liking what I'm seeing. Okay. Documentation checklist, income documents. So employment and wage income. Remember, guys, everything that they should be filing already is reported to the IRS. The IRS is really just like, let me see what you're talking about. So people think they can outsmart the IRS. People think they can report things when they want to. You can't. And the IRS, honestly, because people being on so much foolishness over the years, it has just really made the IRS smarter, and it has made them move in a way that's not like technically in our favor. Like it's just made them wiser. So we need to be as accurate as possible with the filing so that the client can get paid and so that we can get paid. We don't want the client's refund held up. Because we don't want to be held up either. So it's not in our benefit to try to cut corners. It's not in our benefit when the clients say, I know I got another W-2, but it's only $5, so I don't want to file it. Don't do it, because it can just really hold up everything. And guess what? The taxpayer gonna be calling you, where my refund at? I ain't got my money yet. You know what's going on? They gonna forget that they said, I only had this additional W-2, and then you get the W-2 and the W-2 got $15,000 on it. So if they giving you additional information, things that are red flags, guys, we're going to check into it, and we don't want to transmit it unless we feel secure that they have given us all of the information. So the employment and wage income, the investment and financial income, self-employment and business income, government and other income. Deductions, credit, and banking information. So the tax credit, the common deductions, banking information. That's another thing. The IRS is no longer issuing paper checks. All individuals need to supply banking information. All individuals need to supply banking information. So we need an account and routing number if the person is expected. We do have options for the person to get a check through the bank. That's not technically ideal. And then we will be able to also offer prepaid cards as well. But it's best if the person have their own account and their routing number. And we always want to have an intake form that allows the client to verify all the information provided is true and accurate to the best of their knowledge. I understand that I'm responsible for the accuracy of this information, providing that the penalties may apply for false or fraudulent information. This is what the taxpayer is signing and saying. So you're giving them this intake form. So this is why you don't want to just jot down all of their information on a piece of paper. You want to give them something that have them with accountability. So a person gonna kind of think a little bit more when they see this section that's saying I'm signing this and this is true and this is accurate to my knowledge versus you just sitting down and taking notes. You writing down their name, you writing down their kid's social. Let them fill all that information and then provide you with the additional documentation for what they're putting down there, not you just taking notes. And then when things happen, they say, well, I didn't say that. I didn't give her that. I don't know. Completing the intake process. We want to review and acknowledge, document completeness verification, secure record keeping, and data protection. So review and acknowledge. Once all documents and information are collected, conduct a thorough review session with the client, have clients sign essential documents, including comprehensive intake form, engagement letter or partnership agreement defining scope of services and responsibilities, and due diligence acknowledgement. Explain taxpayer responsibilities, prepare limitations, and the importance of accurate information. Address questions, clarify any areas of confusion before proceeding to return. Prepare to return. We want to double check that all required documents are complete, legible, and properly dated. Verify all W-2s show complete employer information, accurate withholding. Guys, in the all of the data must be unexpired. So if a person have a driver's license and it's expired, I don't know why in this country when there is an expired ID, it's like, oh, it's no longer you. It just don't work. It's the same here for us. Even if you try to we have to plug in the ID information into the software. If the expiration date is within the time frame of when you're trying to enter in, the system will not accept it. And again, we want to store all client documents, intake forms, supporting materials in a secure encrypted system, complying with IRS security requirements. Form 8867, pay, prepare due diligence checklist. This is the form again that I was telling you that is near the end of the e-file. We'll be able to look at this in real time when we go through the next software training. So the due diligence is go through eligibility determination. It goes through record retention, information verification, and knowledge standard. Credit and status verification, check all applicable items for each. So this is basically, I mean, it's saying the same thing over and over, but it just drives home my point as far as how important it is to make sure that we know that clients can actually claim these credits. The earned income credit and the child tax credit are the most widely abused credits. And the preparer certification of preparer signs under penalty of perjury certifying compliance with all due diligence requirements. So every return that your name is on, you are holding yourself accountable to these due diligence standards. Exceptional tax professional view form 8867, not as a burden, but as a framework for quality service. Integrate due diligence into your standard intake process by maintaining detailed notes of client interviews, creating comprehensive document checklists, cross-referencing information across multiple sources, and documenting your analysis and due decision-making process. And sometimes you might have, a mom coming in and she coming in with her kids, and you might say, well, where is dad? Where, is dad in the picture? Does he take care of them? And, she might say, well, he ain't nothing and he don't do this. You record what they say. So we not here to be detectives or anything like that. We just here to say, I did my job. So remember that due diligence protects everyone. It protects the taxpayer by ensuring they receive only credits they're entitled to receive, protects the tax system by reducing improper payments, and protects professional practice by demonstrating adherence to IRS requirements and professional standards. Because one thing I can tell you is, if it comes down to you or a taxpayer, the taxpayer is going to throw you under the bus. So no matter how much you the goat for how much money you didn't got them, no matter how happy they are in the moment, when the IRS get involved and it's questions to be had, it's gonna be you, my taxpayer. I didn't know, she didn't tell me this, that, and the third. So if it's you or them, it's going to be you. So at the end of the day, we always have to CYA. We love our clients. We're gonna serve them, as best as we can, but we also gonna keep our freedom, because I don't know, if you look good in orange or stripes, drop me some love in the chat, because I don't. Who look good in orange or stripes? No, I think that's the first time tonight I ain't seen my chat move. Okay. I ain't going to jail for nobody. Okay, that's what I thought. Okay, so we just want to thank y'all for y'all commitment to excellence. I know this was a lot tonight. We will be recapping in our next session together, and then we got more software training. So let's see. I know everybody here is pretty much in the school community. You'll get more information about the due diligence guide, and I'll be going over that more with in the next software training. So anybody have any questions about due diligence, about the from the first PowerPoint to now? Any questions, any concerns?
I did want to throw in something about due diligence. This was a situation I dealt with probably my second year, I think, being a tax preparer. I had
Okay.
this one gentleman come to me, and this is not uncommon, guys. You will see people do this, but he was trying to file for his wife, and he was trying to help me, or he was trying to get her information sent in. She's not so tech savvy, da 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 da. He had a million and one reasons why he was doing it for her. So, I still go to pull up the information because I'm gonna look at it. Why not? They put the information in my system, so I look at it. What made me kind of question the whole situation was the W-2 looked kind of crazy. Like something, I don't quite recall what it was about it, but something about that W-2 just looked off. And mind you, you see many W-2s, many tax forms every day. So when you get that one that look kind of crazy, like somebody done typed it up, it'll stick out to you. You'll recognize it. And he's like, oh, this is my wife W-2. She done worked at this daycare in Kentucky for 5 years. And I don't know what made me go look up that address on that W-2, but I did. And it actually came up to a house that wasn't, in fact, in Kentucky, but the house had been for sale for quite some time. I'm talking like maybe like 2 years, because I think something had physically happened to the house. So you're telling me that your wife just worked there for 5 years, but the state of Kentucky or Remax or whomever is telling me otherwise. So it kind of like raised some red flags in the whole situation. But point being said, you will see all kinds of crazy stuff. So if you cannot make sense of the situation, if you can't make it sound good on paper, from the legal aspect of what the IRS would expect, do not do it. Just like you see those signs in stores that say, I'm sorry, my kids are talking in the background, they won't go away, but just like you see those signs in stores that say, we reserve the right to refuse service, you do. If it doesn't make sense to you, it's not worth it because you're getting what, $400 or $500 off this client, which could potentially cause thousands in penalties for due diligence. Like, it's not worth it. By all means, do your due diligence on every client, even some of those closest to you. You would be surprised.
That's good stuff, Karen. It is. So that is the blessing of like working with experienced individuals. We've seen a lot. Not that we know everything. Like I said, the tax laws are long and wide. Nobody can know everything, but we've been around the block. We've seen a lot. We've serviced a lot of clients. So if you're serious about becoming a tax professional, you are in the right place. And if you're serious about doing it the right way, you're in the right place. And most of you guys, you continue to show up, you come into training, you guys are, participating, you really setting the tone to have a fabulous tax season. And y'all should give yourselves drop yourselves some hand claps in the chat, because y'all really been showing up. So that really say that y'all taking it serious. Yes. Any questions? Y'all quiet tonight. I guess I'll take it that I hope I did good. That y'all don't have any questions, and then we're gonna tie it back with the software training next week. So we have that. And then I wanted to do a poll. I wanted to see who would be interested in adding credit repair to complement their tax business. We're thinking about doing a class for that. So show me something in the chat if you interested in hearing more about adding credit repair. So that's definitely like a marketing tool to add. It's also an opportunity for more money. So we was kind of brainstorming about that earlier today, how we can throw in a class for that to teach y'all, introduce that to y'all, to the individuals who will be interested. And it's not even something that you have to do ongoing. It's something that you can add complimentary just during tax season if you wanted to. So I want to see how many people, Candace in the chat,
You can also tie the fee in for credit repair to your tax fees also.
Yeah, that's definitely what's happening. Okay. So we're going to put, if we get enough people that's interested, we're going to put something together to have a class for that for you guys. So we want to make this a great opportunity. Like, we do a host of things over here, and we want for you guys to be able to grow and do those things as well. So let me see. Okay, and Candace said that she also added some more classes in the school group. So we got a lot of stuff. So y'all pump up y'all tanks. I know it's almost Thanksgiving. We're gonna give y'all a little rest, a little breather during Thanksgiving, and then we coming right back full-fledged. We gotta go hard before Christmas. Then you got Christmas, but right after Christmas, what you got New Year's, and it's taxmas. You got January 1st, tax season start January 2nd. We less than 50 days away. So I don't know how many times I said this, but it's like, Alexa, skip Christmas and go straight to taxmas. Like, take me to tax season, baby. Take me to tax season, baby. I don't even care about, I don't want to spend no money. I want to make some money. So, baby, it's 9:24. Let y'all off of here, because I'm just running my mouth. So if y'all don't have no questions, good night. look for, I'm gonna get with Candace to see what y'all was saying in the chat about the credit repair. And we got, I know we got another training on Tuesday. I'm confused in this moment, whether it's software or whether it's taxes, but plan to see me on Tuesday. I plan to see y'all. Thank y'all for being here. Good night, y'all.
Good night, everybody.
Thank you, everybody. Good night.
Good night.
Good night and thank
Good night.
you.
Good night.
Don't forget to check your school groups, guys.